I'll shift to another subject now on capital flows. We have been experiencing excellent flows despite the dip the middle of the year, last fiscal year. We got about $50 billion foreign portfolio investor flows.
Yeah.
And I'm not even getting into FDI here. So as the new year dawns, the new fiscal year dawns, and our inclusion in global bond indices, we are expected to get even higher flows. And if the US interest rate cycle turns, there's going to be a lot of inflow of funds into Indian markets. Now, how prepared are we to handle this kind of surge in flows?
Right.
And what impact is it going to have on the economy? Because if the RBI, we already seen in the last 2 weeks, 3 weeks, the RBI trying to sanitize, buying up dollars and keeping the rupee at a stable level. But is that going to be a feasible option going forward in the face of billions of dollars coming in?
It's very valid questions, Raghuvir, but compared to 2003 to 8, when we had capital inflows which were very high year after year in that growth era before the crisis happened, our economy was a much smaller size. Now we have a size of $3.7 trillion, and several sectors have opened up. And for example, the PLI scheme identified 14 sectors where we are looking for investments from domestic and foreign investors. So, and semiconductors is an area which is capital intensive. So I think there are more opportunities for the capital to be absorbed productively. And yes, ultimately the answer is in whether we sterilize those inflows, in which case, or we simply, if we keep buying the dollars to keep the exchange rate stable, then naturally it has a spillover effect on domestic credit creation, so, which can lead to overheating and also allocation of credit to non-productive areas. So we have the global empirical experience in these areas is well known, and RBI is well aware of it. But my hope is that given the size of the economy and the various investment opportunities, we'll be able to deploy them more productively than we have been able to in the past. But we have to be aware that sometimes it could be a problem of plenty rather than scarcity when it comes to these investment options, because the world is looking at India as an investment option very closely, given that other countries have much more formidable challenges. And therefore, this should actually then become a good trigger for us to undertake many of those reforms which are more granular in nature, that will help us absorb this capital more productively. It should become an impetus.
But is work on that front?
Yes, indeed. I think definitely we are. I mean, the very fact that the Prime Minister is talking about what are the actions that need to be taken in the first 100 days and then the first 360 days, etc. There are clear thinking. And to go back to my earlier point, some of the areas that require reforms do not just rest with the union government. They rest with state governments also on laws like labor markets, land markets, and the last mile issues. So so it requires both the union and the state governments to get their reform process moving so that these capital can be productively absorbed. I think prima facie, I can say the chances are much better than two decades ago, when we were having more difficulties in absorbing the capital and the investments went into a few sectors. But this time we have more options, investment options. But it's also, as I said, this should also become an impetus to do more in those areas where the capital can then flow.
But what does it mean for capital management itself by the RBI, flow management?
So that is something we need to think about. What do we do with the exchange rate, right? I mean, do we let the currency appreciate, or if we continue to intervene to keep it stable or to prevent it from strengthening too much, then what is the domestic implication in the credit market? And what about the kind of bubbles or asset mispricing it can create? And once again, make credit flow into a few sectors rather than in a more diffused manner. Those are all very important questions to address as we see how these flows evolve. Because, for example, in a world where exports are going to be anyway challenging because the global growth is going to be uncertain and more volatile, and countries are imposing both tariff and non-tariff barriers on trade, etc. So will simply keeping the exchange rate competitive be enough to drive your exports? sometimes you could use a slightly stronger exchange rate as an impetus for productivity growth and technological innovation by businesses to make themselves competitive. So all those trade-offs have to be evaluated, and I think we are looking at these dimensions to see what kind of policy. Ultimately, there is going to be no perfect answer to any of these, because economic policy making is all about these trade-offs, and we need to we are aware of these trade-offs, and we are examining those issues. Yeah.
Nice to hear that. I have a doubt here. We published a story last week about the LRS, Liberalized Remittance Scheme. $27 billion in just 10 months compared to $27 billion the whole year last year. And it's likely to exceed last year's target. Now, on the one hand, we are talking about how to manage capital flows. On the other hand, we are clamping down on genuine aspirational expenditure of people. The people want to travel abroad. People want to send their children abroad for higher education. And we come up with measures to control that as much as possible, like the TCS of 0.5% last year.
Clamping down the LRS $250,000 per person per year still remains. What has been clamped down? So there is no revision to the number. The number has not been lowered.
No, but you're making it more difficult, right?
No, I think it is about documenting it, and it is about making sure that the inefficiencies and the loopholes are not there, so that the scheme, well-intentioned as it is not exploited for other purposes.
But when I buy a air travel ticket, I have to give my PAN number. When I send my son or daughter abroad, I have to declare my PAN number. So you have controls there. Why another 0.5% TCS there?
I think that has been. I think there have been multiple adjustments and changes made to that scheme to make it relatively a non-issue for a vast majority of the remittances, I think.
So my question is, should we allow aspirational Indians to spend more abroad when you have so much capital flows coming in? I mean, why are we still sitting in the old mindset?
Right? We are not stopping them, because anyway, this we are not imposing any additional tax on this. It is something that you can set it off. Maybe it is a paper work process, documentation issue, but even that's why I'm saying that this has been made. I mean, there are exemptions and spending limits below which it doesn't apply. Those kinds of changes have been tweaked based on the feedback. And as I said, in fact, India's liberalized remittance scheme is actually more liberal than many other developing countries, which are of even bigger size than ours. And that nothing has changed in that, in terms of monetary limits.